Welcome to episode 3 of Talking Central Banks podcast with me, Karan Medici. This platform is exclusively dedicated to everything central banking, monetary economics, and policy technicals for observers across the world. Today, we will be doing our North America roundup, covering central banking stuff pertaining to the US, Canada, and Mexico. Our special guest tonight is eminent fixed income expert John Rothfield. John brings here a number of decades of experience in economics and financial market analysis within both private and public sectors. His career began at the Australian Treasury in the 1980s, and after receiving a Commonwealth scholarship, he completed a PhD in economics from the UCLA. Moving permanently to the US in 1989, John has acquired more than 2 decades of experience working in global commercial and investment banks under the global research function, analyzing the US and foreign economies and the drivers of interest rates and currency. Those banks included First Chicago, Nations Bank, Bank of America, and Merrill Lynch. In 2012, John took up the role of Chief Economist and Investment Director, cum Portfolio Manager for CalPERS, the largest US public pension fund. Apart from investment advisory, John was also lead manager on some of the fund's fixed income programs. More recently, he has started a consultancy advising on macro and interest rate trends, presently for Derivative Logic, an interest rate hedge advisory firm operating out of the Bay Area in Northern California. Welcome to the show, John. It's a privilege to speak to you today.
And it's a great pleasure to be on your show, and also very aware of the importance of India in the future growth of the global economy, and a lot of interesting things happening there, but also in my neck of the woods in North America as well.
Looking forward to it, John. It's always a privilege to speak to you. Starting with the US, John, the Fed commenced an easing cycle late last year, but has held rates for 5 successive meetings in spite of a significant slowdown in the US economy. Is there any substance to the criticism of the Fed's inertia, in your opinion?
Well, I want to come at this from a few angles, but the bottom line is no, I think the Fed has done the right thing by a number of respects. Now, the first point to note is that some other central banks around the world, their peer group central banks, have been easing more aggressively than the Fed. One
Right.
example is the Bank of Canada, which we may discuss later, the ECB, the famous Bank of Switzerland, which President Trump would like US rates to be closer to, and
Yeah.
a country like New Zealand, for example. But for every one of those, there's also a country such as Norway, Australia, for example, and the United Kingdom, which have adopted a much more cautious approach to easing. And I think the important thing to note is that every country's circumstances differ. One thing that differs in the US compared to anywhere else is that the loss of output growth relative to the pre-COVID trend has been much flatter in the United States and everywhere else. Every other country's suffered significant deterioration of actual and maybe potential growth. The US didn't do that, partly because of its fiscal policies. Fiscal stimulus was happening. And as a result, measures of the output gap arguably are closer to flat. Another factor is that when the Fed did do 100 basis points of tightening, easing toward the back half of last year, one should note that 50 basis points of that was before the election, another 50 was after the election. So there was nothing political about what was happening. It was President Trump had already been elected when the second and third of those rate cuts happened. But at that time, the labor market in 2024 actually started weakening. 5 years into the economic expansion, which started in April 2020, the Fed could see that the unemployment rate was rising. There are 2 rules. There's one called the SARM rule, which says that basically a 50 basis point increase in the unemployment rate versus the lowest 3-month average of the prior 12 months, that had got to 0.5, which is right on signaling a potential recession. There's something called the Machares rule, which combines SARM with an element of job vacancy declines. And that was saying that by August of 2024, there was 36% chance of a recession happening pretty soon. So Inflation was still well above target in the US, but you were starting to get the weakening of the second element of the dual mandate, which I think was a key decision point for the Fed. Since then, those SARM and Maches rules have flattened out, and we're not seeing any evidence of recession coming from those rule-based measures of the Fed funds rate. A third element to note is that the Cleveland Fed has something called a monetary policy dashboard, which is based on rules for monetary policy setting, things like the Holstein-Williams R star measures, different measures of R star. Those Taylor rule measures and various other measures are basically saying that the Fed funds rate right now is roughly where it should be. The Fed has mentioned this a number of times in its monetary reports to Congress. And not only that, but based on forecasts by professional forecasters and the CBO, that neutral nominal rate doesn't change much over the next 18 months. So basically, if you went purely by the rules, the median of all these rules is telling you that the Fed funds rate is around about where it should be in the low fours. A fourth factor is that yes, domestic demand growth has slowed to about half its rate under Biden-Harris, but I would note that in the third quarter of the year, the tracking for GDP is actually pretty strong at 2.5%. So we're getting back toward higher numbers for that, and also the unemployment rate has been steady this year. Inflation, according to the 9 measures in the Atlanta Fed's dashboard, are still at 3.25%. So it's well above the 2% core inflation or underlying inflation target. And then, of course, we have very frothy financial markets as well. The price to book ratio is extremely high. What they call the Buffett rule of the value of US stocks relative to GDP is at 2.25. Buffett sells stocks when that gets to 2. And so financial stability is not part of the Fed's mandate, of course, but we learned from the early 2000s, you have to lean a little bit against financial frothiness because you don't want to be cleaning up the mess afterwards. I don't think we're in a frothy state yet because there's reasons why market valuations are so high. But it is something to say that, hey, what's the problem that we have rates at this level? Because it's not preventing, strength in asset prices outside of, say, housing, which have leveled out a little bit. And then the fifth thing is that really policy rate hasn't been part of the slowing of the economy. Earnings in this latest round have been up 11% year on year, which is high in real terms. The interest coverage ratio is extremely generous still. The firms are not getting hit by that. There's a small business survey. Small business is 2/3 of the economy. The small business survey says that only 3% of companies cite their main problem as being where interest rates are. And then, of course, the final factor, which I think Jay Powell has alluded to a little bit, is that the Fed doesn't control the long end. And the long end has been hit by various factors such as higher budget deficits and the rapid expansion of growth in data centers in the US, which has kind of sucked in a lot of the incremental capital spending in the US, as opposed to some of the industries like office or residential construction, etc. So these are outside the Fed's ambit. And I would finally say on that, the US Treasuries have actually outperformed Bunds, Gilts, and JGBs this year. So it's not like stable Fed policy has actually caused rates at the long end to remain frustratingly high. It's been other factors. So overall, I would say if you take all those factors together and the unique aspects of the US and all of those other considerations I've mentioned, I think the Fed has been right to stay paused on rates this calendar year.
Since you mentioned about the lack of control of the Fed on the long end, do you think Operation Twist could be a possibility just to stabilize the yield curve?
You're already seeing elements of that now, and Scott Bessent was critical of Janet Yellen for doing similar in terms of where they were doing their issuance. And so the Fed has managed to leave its auction sizes at the long end of the market relatively stable for now. And a twist operation is a legitimate way of managing your exposures. And the administration actually does believe the budget deficit will come down. I don't think it's going to be coming down, but they do believe they're kind of buying time by doing these kind of operations. And I don't think it extends to the issue to the level of, say, yield curve control, which is what the Japanese were doing, very actively
Mhm.
targeting and announcing a JGB yield target. I don't think it goes to that, but I think a twist is fine in the current circumstances.
And John, you also mentioned about the froth. And it seems after COVID, a lot of corporations are sitting a lot of liquidity, which probably is because a lot of capital expenditure is on hold. And that is also adding up to the reserves in the system, which seem to be pretty sufficient at this time. And the Fed balance sheet is also not contracting the way I think most of us were anticipating earlier. What are your thoughts on that, especially pertaining to the froth that you mentioned?
We ran into this at CalPERS. I joined CalPERS in 2011, 2012, but they were still talking about, how they dealt with the financial crisis in 2008, 2009, when there was a drop in liquidity. During COVID, we went from kind of monthly meetings of the investment committee to daily meetings, because the main concern was whether the markets would remain functional, etc. So that element of functionality in markets, the availability rather than the price of credit, has become a significant issue. The Fed has moved from a scarce reserve system to an ample reserve system.
Hmm.
M2, since the 4 cuts late last year, M2 has been rising at a solid pace in the
Hmm.
last 12 months. So yeah, if you're talking about the availability of money as opposed to the price of money, I think that's a significant thing to say, that in the current circumstances, that's probably the most relevant thing uh,
Right.
for the Fed.
Hmm. Do you think the money multiplier could have an impact on the way Fed plans its forward guidance and monetary policy in any way?
The money multiplier and things like money velocity have been so volatile over time
Hmm.
that I don't think that's going to play. They will have a review of the Fed's policy framework.
Framework.
5-year
Yeah.
review is due later this summer. We're about to end the summer in the US. We're on Labor Day right now, so that could be coming out around about the time of the September Fed meeting. And I think there will be changes to that. It's going to be interesting, given the political environment, to see what those changes would be. But I don't think that. I think that those things like the availability of money and that impact on GDP, etc., are probably not something that's going to be too concerning for the Fed in that framework discussion.
Right. John, you recently shared on LinkedIn a very interesting chart on inflation-adjusted gold prices. The chart basically shows that the commodity prices are highest right now since 1973. If I understand correctly, John, after a brief trough during COVID, the spike seems never ending. Your thoughts on that?
Yeah, I remember that I have a personal stake in this as well, because when I started the Australian Treasury in 1980, we were seeing these stories coming out of the US that dentists were putting palladium in people's mouths rather than gold, because in relative terms, prices had become relatively
Yeah.
expensive. It was a rather remarkable time. And that, I think, on a monthly average basis, we've blown through that high, and we had another high in 2011 when Japan had its 311 and there was the Greek debt crisis, and people were looking for security in their investments. And I think, right now we're in a situation where people are worried about the expansion of global debt and its monetization by central banks, and they need something safe to go into. We're not sure about where Bitcoin's going to end up as its use in the economy. And I think it's fairly rational to see gold where it is, and it's a sign that globally you're in this framework where there's got a lot of debt. And, to some degree, in nominal terms, it has to be inflated away.
I can't help but not ask this, John. Generally, gold and US dollar going opposite direction. Uh, and that's a usual stance. But recently, we're seeing the trend not going in that direction, and it seems that both gold and USD are appreciating. What are your views on that?
Yeah, certainly over that period from 2011, when I first joined CalPERS, 2011, 2012, the dollar went through a 53% real appreciation. That's been part of the problem that's ended up with the trade deficits that have led to the tariffs, really. And over that time, gold was actually, yes, you're right, performing well against a rising dollar. In the more recent time, of course, you've had about a 5 to 10% correction backward in the dollar. And that to some degree has kind of helped gold rise in terms of the dollar. But yes, I took a look at this again recently. The correlation between real gold prices and the real dollar hasn't been that particularly strong in the last 10 to 15 years. So there's
Yeah.
special factors like inflation expectations, which are affecting gold more than just its mechanical link with the US dollar.
Mhm. Talking about the next Fed chair, John, what are your thoughts about Hassett becoming the next Fed board chair? Any particular commentary and how different he will be as compared to Powell?
Yes, that is still a really interesting question. I think that the president allegedly has widened his search to about 12 different people. I think I heard somebody else, another economist, say the other day that he's got this wide field. It's a little bit like reality television, and he wants all of these 12 people to be falling over themselves, saying that rates should be lower, because
Yeah.
essentially they're looking for this job. And some of the names that have come up are a little crazy. A couple of private sector economists who are unabashed Republicans are in the mix for this position. David Zervos, Summerline, etc., have said that they've been approached by the
Hmm.
Fed to do this job. But I think that again is just purely noise. And then you've got, if you look at the betting markets on who's going to be the next Fed chair, it still comes down to Waller or James Bullard or even Laurie Logan from the Dallas Fed, although she is fairly hawkish on interest rates. But she ticks a few other boxes. So I still think that they will ultimately choose somebody with a central banking background, like James Bullard, for example. He
Hmm.
has the advantage of not being on the board now, so they can bring him in, whereas Waller's already in there. And Bullard is very respected as a technician, but also believes that rates should be lower. But as to Hassett, Hassett is basically he's now chairing the National Economic Council. He used to work for Mitt Romney, and he'd been on the American Enterprise Institute, so he was a very kind of free market guy. But recently, he's fallen in line with he's very much a Trump loyalist ever since 2016 when he came aboard with Trump. So he's got a PhD, he's got macro policy experience, but I think the market would see him as partisan rather than following clear rules on monetary policy. And so that I think would be an issue for the market. He would probably get through the Senate Banking Committee approval process.
Hmm.
There is some respect for his knowledge, but again, I think it's ultimately going to be someone with a central banking background. A country like Japan has in the past alternated the governorship between a central banker and someone from the Ministry of Finance. But I think in the case of the US, it's more likely to be Waller. But anyway, someone like Hassett would be on there. And like anybody else who gets that job, it's the matter of persuading, under the current structure that the Fed is set up with, it's a matter of persuading the other 11 voters and all 19 members of the FOMC that rate cuts should happen. And there's no sense necessarily that he, with a non-central banking background, would be more persuasive in that way than anybody else.
So whoever comes now, John, uh, he would be under pressure. He or she would be under pressure to lower rates, irrespective of how the inflation trajectory is panning out. Uh, given the fact that core inflation still seems to be a bit sticky. But I think the way Powell is under pressure, I think that's something that the next chair would have to overlook.
Yes, that's right. It's a little bit like anybody's appointment to the Supreme Court, right? You're not necessarily mimicking the line of the administration, but you choose someone for that role who happens to believe what you do.
Hmm.
And I don't know how disingenuous some of these folks are in terms of saying the same thing the administration is, because the case for significantly lower interest rates is just not there. So to some
Right.
degree, there's a disingenuous element of these guys who are parading for the job are in their public comments. If you have a rate at somewhere between 1% and 3%, I think the consequences for the long end and things like inflation would be very dire.
Right.
Yeah, if the other members of the board think there's a political element has kind of come in like a Trojan horse to the board, then
Hmm.
I think there would be resistance. And so one other economist mentioned we could go back to the old days where there are dissents on both sides. So Bowman and
Yeah.
Waller dissented on the no cut, but if there are cuts, there could be folks on the other side of that, like Goldsby, etc., who could dissent against cutting.
It would be interesting to see how the dot plot evolves from once the new chair is in place.
Yeah, the dot plot right now has a fairly, 75 basis points by the end of next year. It's fairly conservative, actually. 3 cuts
Yeah.
in
Mm.
14 months, 16 months or something. Whereas the market is at 5 cuts, so the market is 50 basis points below where the dots are. And I
Mm.
don't think that when we come to the September meeting, I don't think the dot plot's going to change that much. The dot plot basically has 4.5% on the unemployment rate by the end of the year.
Yeah.
We're at 4.2 now. A lot of people believe in the US the steady state unemployment rate now, payrolls growth right now is only 80,000, 75 to 80,000, because you're
Right.
throwing all the foreign-born workers out of the economy.
Mm.
And
Yeah.
so even if you continue to get low numbers around 100,000 a month, it's not necessarily the case that the unemployment rate's going to rise to 4.5%. As to core PCE, inflation being 3% by the end of the year, well, the inflation nowcast done by the Cleveland Fed says we'll already be there by August.
Mm.
On that. And then with economic growth, we only grew 1.2 in the first half of the year due to various technical factors. So we need 1.6 in the second half to meet the Fed's 1.4. But
Mm.
we're tracking at 2.5 already for the third quarter. So when you look at the summary of economic projections, if anything, we're kind of erring probably toward a higher numbers, or at least the growth will at least hit target. Inflation will probably be above the estimate, and the unemployment rate arguably may not even hit 4.5%. So you would have to find some other factor that would warrant you to lower your dots between
Mm.
June and September.
So we will talk about the summary, John, in a while. But coming back to the Fed board, Stephen Miran, the current CEA chairperson, will be replacing Adriana Kugler on the board temporarily till Jan 31st, 26. With this development, how do you see the Fed's independence evolve in decision making
Yeah, this is
right now?
another partisan hire from outside of the central banking world. So you've got Hassett from the National Economic Council, and you've got Mirren from a loyalist from the Council of Economic Advisors. So it doesn't really do that much confidence for the Fed. Aren't there any technicians who can fill that role? And after all, it's only a temporary fill in the role till January 2026 until they have to find a permanent replacement. But
Hmm.
here's another kind of signal, another Trojan horse inside the Fed, because you're looking at a situation where number one, he's become a major supporter of tariffs, and it's very hard to find an economist who in the cold light of day, if kind of a flashlight was put into their face, would say that they think tariffs are a good idea. And then secondly,
Right.
he has been driving this idea that the Fed, all 19 members of the Fed can vote, and that the Trump can hire or fire any of the regional Fed chairs and anybody from the governorship. So it's
Right.
he's coming into this board and essentially saying that he wants to roll over the whole thing. Now his is only a temporary appointment, and we don't know what's going to happen eventually. But he will probably be. The Fed is probably going to cut in September, but if they don't cut in any meeting between now and the end of the year, it'll be three people dissenting. He'll just be a dissenter, but his influence on the board, given his radical ideas, I think is going to be fairly minimal, and it will partly depend. I think it's more important who's going to be the new Fed chair next May.
Right. Right. The Fed's 5-year review of the monetary policy framework is scheduled for release later this year, and you did touch upon that a bit earlier. What are your expectations pertaining to the implications for the Fed's dual mandate?
Well, 2020, they basically started doing the frameworks in around 2012 when they formalized the 2% inflation target. In 2020, by then you'd had all of the global financial crisis and its aftermath, and then you'd had the pandemic. So we'd spent nearly all of that time, a whole decade, with interest rates at the zero lower bound and with quantitative easing, which is very distortionary for the economy. So
Right.
in 2020, they didn't know that the economy wasn't Japanified, if you like, and that we would ever get away from zero interest rates. And so the 2020 framework was very much developed an asymmetry, right? So on the inflation side, they introduced what they call flexible average inflation targeting, which was something like Australia does, which is kind of the average inflation over a period of time. And then there was an asymmetry in the maximum employment mandate, where you're more likely to cut rates if there's some underemployment rather than raise rates if the market's very hot. We are now in a situation, and Jay Powell has said this a number of times, where we're not in that situation anymore. Rates have normalized. We're probably not going to go back to zero lower bound, touch wood. And so I think we'll get back to a more rigorous restatement of the dual mandate, where it's symmetric around both the inflation and the unemployment and the jobs market mandates. And that's what I think will happen with this particular review, to try and kind of restore the importance of the 2% point inflation target. But of course, operationally, we're in for a period now with the politicization of the Fed, where they're going to probably keep cutting, despite the fact that the inflation is over 2%. So I'm not sure what this framework will mean practically for the Fed, but I think they will restate back to something more like they had before the 2020 statement, which was a little bit more hawkish.
I was talking to Jay Bryson yesterday regarding the US economy and the framework. And I think one of the discussion points was that unconventional monetary policy tools such as QE actually went overboard post-COVID. What kind of impact, John, do you think QE had on real rates and the normalization of the Fed balance sheet?
Well, it's easy to say after the event that maybe too much quantitative easing was done. We started to look. I did a project at CalPERS about whether Japanification was becoming a global phenomenon. We all know that the Japanese bubble burst in around 1990, and then we had 30 years of zero to negative interest rates and quantitative easing. The BOJ at the end owned more than half of the Japanese government bond market. So there was a concern that the distortionary impacts of that, and we had the shadow Fed funds rate rule, which got to about minus 600 basis points based on QE that was happening at the time. So you have kind of a shadow Fed funds rate that overcame the concept of the zero lower bound. But I think that the Fed, what we've come out of this is that the Fed would like to continue to have dry powder. Because it doesn't want to get into a situation like it did in 2019, where it did some easing toward the end of 2019 for no particular reason. It was like a preemptive cut, another 100 basis point or 75 basis point gift to President Trump at that time. And the Fed would like to have the dry powder because it just doesn't want to get back into that situation again. It has moved to an ample reserves over a scarce reserve system, and I think that is a desirable thing. But I think they would like to do their best to avoid having to get back into that zero lower bound and all the kind of distortions that, as you mentioned, that can cause.
Right. Coming back to the summary for economic projections, John, the June 25 edition states that the real GDP growth is expected to decline between 20 to 30 bips for 25 and 26 as compared to the March projections. At the same time, unemployment rate is expected to go up by 10 to 20 bips right until 2027. PCE is also expected to rise 20 to 30 bips incrementally during this period. Are we looking at a stagflationary situation, John, building the US economy? And given this background, how do you see the Fed policy panning out in the year ahead?
Yeah, there is something called the misery index, which is you add up the unemployment rate and the inflation rate, and it correlates pretty well with consumer sentiment. At one stage, the consumer sentiment was so low it was pointing to a misery index of 12%. 6% unemployment and 6% inflation. That has become a lot milder.
Right.
I think. We're looking at a much milder impact of tariffs. One of the reasons is that, importers have borne some of the costs. Profits are extremely high. So some, particularly in the auto sector, have borne some of the cost of tariffs. And then a number of folks are finding their way around paying tariffs. But tariffs are still yielding $30 billion a month, which is a pretty high number relative to consumption. So when you talk about stagflation, we're not talking 6 and 6, which was basically the worst fears after the famous Liberation Day, that horrible rollout of tariffs that happened at the time. But we're probably talking about something in the high 3s for CPI, and that allegedly transitory. And inflation between 3.5 and 4 is the peak. But that would be transitory, and we would end up back at 3% or lower by the middle of next year when these numbers from tariffs drop out. And then with the unemployment rate, who knows where that's going to end up, again, because of this idea that the Fed's, that the administration's policies in other areas are leading to a severe curtailment of the growth of the labour force, so that the new normal for payrolls growth, just to keep the unemployment rate where it is, 4.1, 4.2, is much lower. So I think we're in a situation of some stagflation, but nowhere near as bad as has been thought before, and well within the bounds of some occasions in past business cycles. The Fed has definitely faced this problem with its dual mandate, but I don't think it's as stark as people had once feared.
Given this newfound revenue stream from the incremental taxes, tariffs, if I can say that, what impact, John, do you see on net issuances and the impact on the yield curve? Because if the fiscal authorities have additional revenue, then that would probably reduce the net issuances in the year ahead. What are your opinions on that?
Yeah, so right now, tariffs are running at a monthly rate of 30. They used to be 8 billion a month, so that's an increment of $200 billion a year to Treasury's coffer. And when you look at the numbers, the Congressional Budget Office for the One Big Beautiful Budget Bill has an increase to the deficit dynamically scored at over $4 trillion. And then you can look at tariffs as maybe providing an offset of a little over half of that on a static scoring, or even a dynamic scoring, you're getting a little bit less. And so,
Mm,
tariffs are roughly, if the numbers are to be believed, paying for about half of
mm,
the effect of the one big beautiful budget bill. So you're still looking at a situation where, as we mentioned before, Scott Bessent will be doing more bill issuance, etc., in the short
mm,
term. But in the long term, they're probably going to have to increase issuance next year. Now, whether that becomes a problem, I don't think it's going to be a problem to the same magnitude as, say, in Italy or a Greece.
mhm,
Or other countries, or they won't have to go to a situation like Japan where the budget deficits were so high and persistent that the central bank had to do this massive outright buying of the issuance. But I think there will be an increase in issuance, and I think that the term premium will remain elevated, perhaps even more elevated. And I think
mhm,
the inflation component of a bond yield will also remain elevated. So what we're telling clients in the current firm that I'm working with is that regardless of what the Fed does, and I do think, to answer your earlier question, I think the Fed won't do the 125 basis points that's priced in between now and the end of
mm,
next year. It will do some kind of subset of that, depending on
mhm,
the evolving economic conditions. After all, the administration is looking for a so-called rocket fuel economy. So I think they will only do a subset of that, which means that the long end has got too much easing priced in. And then I think
mm,
inflation expectations will probably go up from here. So what we're telling clients who have an exposure at the 5-10 year part of the market is that rates are going to remain elevated and may
mm.
even test the upside of this year's range, which was, I think, 4.75 on the 10-year bond. And there will be an incremental increase in issuance. And the administration's negative approach toward foreign governments isn't exactly encouraging countries to be buying treasuries. But I think one way or another that will be a digestible problem.
So, given the term premium that you mentioned, the rising term premium, would it would be safe to presume that the yield curve would steepen even more?
Yes, I think so. When you look at the history of Fed rate moves, the twos, tens steepens
Mm,
every time that the Fed is cutting rates to some degree. So even if we get less easing than is priced in, that would limit the further steepening of, say, twos, tens. But I still think it's going to happen to a modest degree from where we are now.
mhm. Uh, if I can touch upon the dot plot one more time, John. Despite an expectantly higher inflation print in the next 2 years, the dot plot is suggesting a fall in Fed fund rate over the period. What do you think is the thought regarding this among the FOMC members as we speak?
Well, I think that we still have flexible average inflation targeting, and provided central banks are forward looking, they're not just looking at the current inflation print. So, as you say, the even further out to 2027, that you still have core PCE at a little above 2%. So we're coming
Mhm,
back to the idea that Jay Powell has said, which is that policy right now is mildly restrictive. So what you're really saying is that 1, 2, 3 rate cuts over the next 12 months would take away that mildly restrictive element if the other element of the dual mandate, the labour market, doesn't rebound from here. And the administration is looking for a re-acceleration of jobs growth because we have all the policy pieces in place now. We think we have the tariff. We know to some degree with more clarity what the tariff rate's going to be. We know what the tax environment's going to be for US businesses. So in theory, that will unleash more certainty around hiring decisions. But I think we're still in a 90-day, tap dance with China in terms of tariffs, and there are still uncertainties around the administration. So I don't see a huge acceleration in jobs growth from the shock revision to the numbers that we had recently. There'll be some rebound, but probably not that great. It'll continue to be native-born rather than foreign-born workers because we're trying
mm,
to change the structure of the growth of the US economy. But the arguments, there will probably be some persuasive arguments that the labour market is further away from its mandate than inflation is when you consider if you believe that the tariff increases are temporary. And we do have the Fed has eased in the past when inflation is above 2%, and so have foreign central banks. It's ultimately what you think the path of inflation is going to be.
The real US GDP growth is nevertheless expected to converge to the long-term average of around 1.8 to 1.9%. Nevertheless, and you did touch upon this point, John, earlier. The climate seems pretty brutal for this chutzpah, don't you think?
Yes, well, the 1.8 to 1.9 is basically is based on the demographics of the US. You're getting rid of foreign-born workers. You have a very low birth rate in the US. Despite the vice president talking about childless cat ladies, we're not getting the growth in the domestic population that one had thought. So potential growth has lowered, and that to some degree reduces the R star, the steady state
Right.
employment rate. But if we're looking at, it's how you get toward that R star. And then in the interim, you've had this massive investment in AI over the last 2 or 3 years. Now 13% of firms, 16% by the early part of next year, are actually adopting AI in their practices. So eventually you'll get to a point where productivity, maybe to 2026, 2027, may increase that potential in the growth rate. But that's not what is the concern of the Fed now. That's all too uncertain about what's going to happen. So, I would say overall that low potential growth rate has kept, R star relatively low, and the neutral Fed funds rate, the long-term Fed funds rate at 3% is a fairly reasonable objective. But again, it's how you get there, and given the outlook for the economy and inflation in the near term, I just don't think we're going to get there as quickly as is priced into the market.
So how early do you think, John, the Fed would, how long would they continue the ample liquidity in the system, the ample reserves in the
I
system?
think they're going to keep that permanently. I think the last three recessions have been essentially due to contagion effects from the real economy back into the financial economy, and you want to try and avoid that. And you're talking about money multipliers and money velocity, etc. before, but I think the Fed is willing to live with kind of some kind of implicit floor on inflation by having an ample reserve system, because they want to avoid going back to where we were with a zero lower bound and quantitative easing. So I think that they're going to continue with that policy of ample reserves, and be very cautious about getting back to a situation of scarcity where there could be dysfunction in the bond market that exacerbates the impact of any slowdown in the economy that happens to be happening. We're 5 years into an expansion. Typical US expansion last 10 years. There seems to be one at the start of every decade. We're only halfway through this thing, but we don't want to. We want to give this thing legs for another 5 years or so.
I think it's empirically proven that the business cycle is around 7 to 8 quarters in the US. That probably, I think the next cycle should probably start sometime next year, if I'm correct. Do you think that would have any bearing over the framework review and the Fed is assessing its monetary policy stance?
Well, I think the framework review is very much a review of the structural elements of Fed's policy, and then you make decisions within a business cycle about where you want to be. The Fed tends to be relatively early in an economic cycle in raising rates, because they don't want to cut it off at the pass too early. And then there's some catch up, and there's some criticism about that catch up, because you're talking about taking away the punch bowl, etc. So the Fed does tend to lag the business cycle a little bit. But again, I think that we're probably getting toward mid to late cycle, because we do have a tight labour market, and we do have some elements of the economy that when you look at the indicators that the National Bureau of Economic Research looks at, we're still significantly away from the risk of a recession.
Mhm.
Things like industrial production, real incomes, things like that, are still relatively benign. And
Right.
manufacturing, trade, and sales is another one that is looking okay. So I still think we're a long way from a recession. So they don't, if the administration is talking about cutting rates, it's not to head off, I don't think, the imminence of a recession. It's more to, provide sustenance for their so-called rocket fuel economy that they need to obviate the problems that they're having with the budget deficit.
Interesting. Regarding the stability of the financial system, based on Stefan Adiev and Jose Maria Sorena's study, banks' market capital is a key determinant of the strength of the international risk-taking channel of US monetary policy. What is your view on this, John?
Well, banks' balance sheets have certainly undergone some transformation recently in terms of the amount of capital that banks are required to hold again after these last couple of episodes, and so so but coming to the study, I think that. The transmission effect that they found, I think there was a BIS study,
Yeah.
was basically done during the pandemic, and you've had a lot of kind of
Mm.
innovation since then, and you've had non-bank institutions, you've had disruption in the financial markets, etc. So it'd be interesting to try and replicate the results of that study coming into the post-COVID area, where we're in a more normal state with strong bank balance sheets, etc. Whether that's still the case with the reduced role that traditional banks
Mm.
have in the intermediation in the US economy right now. So it would,
Mm.
that was interesting for its time, but I'm not sure how important that is now. We see certainly a lot of cross-border lending has been quite strong. I think 7% in the latest year, and I'm not quite sure
Right.
where that growth is coming from. Whether that is still concentrated in those kind of healthier financial institutions.
Mhm. In any case, do you think this is a time for wait and watch, for a wait and watch approach for the Fed? Uh, in your view, how it should act in balancing the risk to the current outlook?
Wait and watch. Well, they've certainly been waiting and watching each all year, and they've got the fancy name of inertia for that. We're basically saying that
Yeah.
we think we are mildly restrictive, but we can afford to
Mm.
wait and watch. Nothing's happened to the unemployment rate.
Mhm.
Inflation is still elevated. All these financial indicators are saying things are going fine. And so, but I think the rubber has hit the road, and we do get one more inflation, one more employment report before the September 17 Fed, and I do think that it's going to be important to see what comes out of Jackson Hole this weekend in Jackson Hole, Wyoming,
Yes.
where they're talking about
Yes.
the transmission of monetary policy. And remember the
Mm.
September cuts last year. The Fed set the table for that with the Jackson Hole meeting of that time. So I think we'll have a little
Mhm.
bit more indication of whether the Fed pricing in the market, which is a 25 basis point cut,
Mhm.
is likely. But I think we're at the point now where, given these downside surprises on the labor demand side,
Mm.
so if a steady state of employment growth is now down to about 80K a month, the underlying
Mm.
actual growth of employment is arguably half of that, 30 or 40,000 a month. So I think that as far as the unemployment mandate goes, I think they will do a 25 basis point cut, but it may be a hawkish cut, not setting the table for further cuts down the road, and it will remain more of a wait and see approach. And the administration has essentially admitted that by firing the head of the BLS. Nobody knows what the numbers really are. And so you have to rely on a number of factors, not only, ADP employment got it wrong as well. And
Mhm.
so I think they will probably do a cut in September, but I think that ultimately their subsequent moves until Jay Powell is replaced, and then we'll see, will be based on the data. And that's an important thing, that the Fed is seen to be independent and going through its processes that have served the American economy so well since the beginning of inflation targeting in, early 2010s.
So how close are they to being neutral?
Well, one thing says, I look at something called domestic final sales, private domestic final sales, which essentially is a fancy way of saying business plus consumer spending. And in nominal terms, right now, that's only been in the first half of the year, and given the tracking for the third quarter, that's only growing at a rate of a little over 4%.
Mhm.
Nominal private final demand in the economy. So that's only growing a little over 4%. And typically the Fed funds rate in mid-cycle is below that. So I would say that the Fed says it's mildly restrictive now. I'd say probably the neutral rate for where the economy is now. We don't know whether we're going to get this catalyst of certainty about policy starting to re-accelerate the economy again. But where we are now, I'd say probably the neutral rate is 50 basis points lower than where we are right now.
Mhm.
And there are two scenarios. One is that we get a re-acceleration, a catalyst from the more certainty about the administration's policy and the tax breaks, etc. We get a re-acceleration of growth, and then of course we get a policy mistake that leads to recession. So there's a bifurcation of views about where the actual rate goes. But I think the neutral rate, if we stay on the path that we're on now for the next 6 months or so, is probably 25 to 50 basis points below where we are now.
Mhm.
And then
Interesting.
again, I would say watch that nominal private final demand number, because again, if you track that against the Fed funds rate over the long term, it's typically below that economic number.
Right. Okay. As we speak, John, the spreads on corporate bonds over comparable maturity treasury securities on net widen modestly across the credit spectrum. What is your view, and why is the spread high at this time? And do you think this is auguring more volatility in the coming days?
Well, if I was still, if I was working in the corporate bond market, I would still be overweight, and I would be leaning against any kind of widening of spreads. And after Liberation Day, we had this massive widening of spreads. People felt there would be an imminent recession with stagflation, etc. And so spreads widened sharply along with that first announcement, and all the announcements that were happening in April. And then we had kind of the taco trade, where everyone said that ultimately, Trump, the budget would be much worse if there was a recession. Therefore, Trump is going to keep recalibrating tariffs. They call it chickening out, but I think it's just recalibrating
Right.
tariffs to make sure they don't have a recession. And then you look at the numbers again for corporate America, very high corporate profits. And a lot of that is the
Mhm.
Mag 7, so small business profits are much tighter than non-financial corporate profits are. But, so I think that the corporate sector with its 11% earnings growth, and again, a lot of that is skewed a little bit toward the Mag 7. You look at that, and you look at the interest coverage ratio, and you look at the potential catalysts for a re-acceleration of growth based on the tax breaks that have been given in the One Big Beautiful Budget Bill. Again, I would be a buyer of corporates on a further widening of spreads if there was a little bit more of a problem in the market, because the problems in the US are the twin deficits, which is the government and the trade side. The household and the corporate side in the US are actually motoring along quite well. And it's amazing the capacity of the US corporate sector to be able to adapt to evolving circumstances.
Don't you think, John, that because of the tariff wars, corporations may have to absorb some of the price hikes in order to, safeguard the households and safeguard the demand, and that would probably impact the interest coverage ratios for these corporations in the near term?
Yes, it will, and there is an element so far. Certain economic commentators have said that it's going to be third or fourth quarter of this year before firms are going to have to capitulate and pass on more of the tariffs than they've passed on so far, which
Right.
which could lead to a hit to their profits. But the other interesting thing is we forget is that I come from Australia where we used to have tariffs and actually cut tariffs to try and increase
Mm.
productivity. But the domestic firms, which are now behind a tariff wall, have more capacity to raise their prices because they have increased pricing power because their imported competitor
Right.
is not having those problems. So yeah, I think you're going to get
Mm.
offsetting effects on profits. And there is always there's a tendency. There was definitely a tendency in the US for there's this whole dance where corporate kind of equity strategists always lowball expected earnings so that they can beat on the upside. That's always
Mm.
happening in the US. But I do think that, people know that the tariffs are out there and they still have fairly solid projections for US earnings over the next 12 months. And AI is
Mm.
part of that, the productivity enhancements caused by AI and the protective element of the tariff wall. So
Mm.
I tend to think that yes, we certainly have a lot of cushion in profit rates. Profits to GDP or profits to gross value added are extremely high right now, and I think that will reverse a little bit. But I don't think it
Mm.
necessarily leads to too much stress in the corporate market at the moment. And
Mm.
you're coming from someone who has an economics degree, so I hate tariffs. We all know about how bad tariffs are
Mm.
in Economics 101, except
Yeah.
there's kind of like a theory of the second best that if someone else is cheating, you should cheat as well. But overall, I don't like tariffs, but I do think I am bullish, and I live here in California. Just now the fourth largest economy in the world, if it was a country. The adaptability of the US economy and the capacity to be able to continue to generate profits, I think, is going to remain there, particularly in this
Mm.
new world of AI. Yeah, and the point about the ultimate point about that is that the Fed's dual mandate doesn't include financial stability, but they do a semi-annual financial stability report because again, this issue about whether you whether you just let financial stability issues you don't take them into account at all, or you lean against them in order that you don't have an implosion of the markets at the end and that you have to clean up and again go back to
Right.
zero lower bound in rates. So the dual mandate doesn't have financial stability, but there's a good reason they have a semi-annual financial stability report and the occasional reference in the minutes to the frothiness or otherwise of
Mm.
markets. So yes, it is the case. Chris Waller actually made a speech in San Francisco recently about the fact that the Fed has more control over demand inflation through its interest rate policy than it does in supply side inflation. Typical example of that now is Japan, where they have a supply issue with rice. You don't exacerbate
Mm.
the tax impact of
Right.
absence of
Mm.
rice by raising interest rates and causing additional problems. So I think that's fair to be said. You can't recalibrate demand enough to overcome a supply constraint. And you certainly got to the case where probably the Fed did over tighten during that supply round. And then you had
Mm.
all those problems with First Republic Bank, Silicon Valley Bank, et cetera, et cetera. But ultimately, I think what has to be done there is macroprudential changes so that it's not the role of the Fed to make sure that the banks through it can't amend its policy target based upon the near term impact on banks. Actually, macroprudential has to
Mm.
change, and you have seen
Mm.
some certain changes there.
Mm.
Again, I come from Australia with the four-pillar banking system. America, when I first
Mm.
got here in the late 80s, we had
Mm.
something called the Bank of Michigan Avenue in Chicago.
Mm.
Basically three branches on one street. And you
Right.
had they had the FDIC, etc. But overall, macroprudential probably hasn't kept up with the deregulation with the regulation that's going on in other parts of the market. And we know that the Trump administration wants more deregulation, but ultimately, I think macroprudential has to align with the avoidance of the kind of episodes that we sporadically get when the Fed has to do its thing with its dual mandate.
Right. A bit on monetary economics 101, John. I think both of us are monetary economists. So I think it's a very relevant question right now pertaining to the debates around nonlinear Philip curve.
Mm.
What happened to the Philip curve, John, that it is acting so differently now than the pre-pandemic period? I think the differences are quite stark as previously anticipated.
Yeah, that's certainly the case. The pandemic has changed a lot of things in the economy, and one is that relationship. And
Mm,
also coming um, out of a recession, you tend to get permanent output loss, which
mm,
has an impact on the shape of the Phillips curve. And the Phillips curve is non-linear anyway. Once you're close to full employment, it tends to be steeper.
right.
So we're definitely in that mode right now. But again, Chris Wallow did a speech in 2023 talking about the unstable Phillips curve, and he mentioned two factors that were involved in his view. One is unanchored inflation expectations. So you
Mm,
have discipline around the 2% inflation target, changes in the labour market and pricing power that workers have isn't
mhm,
isn't unstable. And you just look at things like the University of Michigan inflation expectations. Republicans expect inflation over the next year to be 1%. At one stage, Democrats expect it to be 9%. So very
right.
unstable both within the economy and in general. You have significant workers who are actually the ones that are demanding have pricing power in the labour market. Their inflation expectations are very unstable, and if you're in a market that is tight, you're going
Mm,
to be more wanting, if you're changing jobs, to need a higher
mm,
rate of compensation. And the other thing that Chris Waller mentioned is this difference between sticky prices and flexible prices.
mhm,
The Atlanta Fed
right.
does some sticky versus flexible inflation. Sticky is something like 70% of the CPI. Flexible is more like 30% of the CPI. But there's a greater capacity for firms to more rapidly change their prices. You've almost got automation of price changes in a lot of cases. AI is starting to come into that area, and you're getting
Mm,
price discrimination between different orders of consumers. So I would say that yes, there are some reasons associated with the pandemic and also where we are in the business cycle, but I think structurally we're probably in for a steeper Phillips curve in a more permanent basis than the pre-pandemic period.
mm. Let's see how that evolves, John.
Yeah.
But turning to the Bank of Canada, despite a similar core inflation trajectory to the US, the BOC has been more aggressive in cutting rates, 7 times since its post-COVID peak, to just around 2.75%. This is despite core inflation being sticky at 3%, a percentage point above its target. In your opinion, can this be seen as a response to the impact of the trade war with its southern trade partner, the US?
Well, you're right. The one significant difference between the Bank of Canada and the Fed is that the Bank of Canada, which is one of the first countries to actually have an inflation target, has a range of 1 to 3%
Hmm.
on its inflation. So, and the Fed is very much stuck on its midpoint of 2%. So, and then you in Canada you have quite a significant variation between headline, core, and the so-called underlying, which is things like trimmed mean
Right.
inflation, etc. So new numbers came out for Canada today. Their headline, their trim mean, etc., is still at 3% at the top end of that
Hmm.
1 to 3% band, and then the
Hmm.
core rate, just ex food and energy, is 2.5, and the headline rate is only 1 3/4. So you
Hmm.
can say that for one reason or another those trim mean and various things like that, the underlying inflation rate remains relatively high, but the headline and ex-food and energy are below. And then in the last few years, you've had a significant rise in the Canadian unemployment rate. Again, unlike the US, which did a lot of fiscal stimulus during the global financial crisis, during the pandemic period, Canada didn't. And as a result, it's had this drift in growth and it's had a rise in the unemployment rate. And of course, tariffs are disinflationary in most cases to the paying economy, if you call it a paying economy, versus the receiving economy. It tends to be more inflationary. So there are reasons, I think, that the Tiff Macklem in Canada has been able to ease rates more aggressively than the Fed, despite core or underlying inflation being very similar at 3%. And I would also point out that all but one of the Bank of Canada cuts came prior to US liberation, or prior to the March imposition of tariffs on Canada. So Canada got imposed with tariffs a month earlier than Liberation Day, or a few weeks earlier than Liberation Day. And by then, Tiff Macklem had done 6 of his 7 cuts. And we have had 1 cut since, but they've been steady for 3 or 4 meetings since then as well. After today's inflation number, analysts are calling for 1 further rate cut in September. And so, the Fed has been, the Bank of Canada has been more proactive in cutting rates, or preemptive maybe in cutting rates, but they have had higher unemployment. And again, they did most of this before the tariffs came on. So I wouldn't, Tiff Macklem, and of course we know that the Prime Minister, Mark Carney, used to be central bank governor. So they have kind of a special relationship, if you like.
Right.
I don't know whether you could call it a political relationship, etc. But I think the idea that it's been done to offset tariffs, that Canada didn't know that it was going to be imposed by such high tariffs when Tiff Macklem was doing most of his cutting.
Right. So why do you think they held rates at 2.75? What could be the reason for that?
Why they at 2.75 versus a underlying inflation rate of 3%? They've talked recently 3 elements of. They have 3 scenarios for tariff impacts. Benign, intense, and kind of a middle ground of what effect tariffs are going to have on the economy. And, ultimately, I think that they are worried in more than 1.5 of these scenarios that the Canadian labour market is going to have a lot of problems picking up from here. And therefore, they need to continue with an easing bias, but to some degree now start to become more data-driven. Up until now, they haven't been as much data-driven, but I think going forward, they will be more data-driven in how much cutting they do. And I do think, again, the steady state or the neutral rate in Canada is lower than US. We talk about a fiscal R-star that the IMF has done work on. US budget deficit is 6.5% of GDP. Canada's is 2.25% of GDP on lower economic growth. And of course, the unemployment rate in Canada is close to 7% versus 4.2 in the US. So I think there are arguments to be made that Canada has a lower steady state Bank of Canada target than the Fed does with its Fed funds target.
John, if it's okay and you're not too tired, can we have
fine.
2 more very, very critical questions on one on Canada and one on Mexico? So the one final question for Canada. John, long-term government bond yields could increase response to rapid expansion of government debt issuance around the world, and not just Canada. Actually, it's a global phenomenon at this point in time. But in any case, this could in turn lead to higher borrowing costs for Canadian households and businesses. I reckon that the result would be weaker domestic demand and greater downward pressure on Canadian inflation because of supply-demand mismatches, as we are seeing right now. Do you think the BOC will be worried about the likely increase in the borrowing costs?
Well, you have two elements there. At 2 3/4, because Canada to some degree is justified its lower rate than the US. The bond yield in Canada is trading well through US Treasuries, right? So we're at 3 and
Right.
change on versus 4 and change in the US. So the market believes that Canada has lower borrowing costs are warranted. And quite frankly, if you've only got a 2% of GDP budget deficit, the beta of your deficit to increases in borrowing costs tend to become less important. And then you have the kind of the substitution effect, right? So if people
Right.
are not investing in US Treasuries because they're worried about the burgeoning public deficit in the US, then people are more likely to increase their allocations to places like Canada and Australia. So there are problems to worry about in Canada. One of the problems is the provincial budgets. What's happening in the provincial borrowing requirement, where the requirements are less stringent than they are for the states in the US, which can't legally run deficits. So you do have some issues going on in the various provinces and the spreads over Canadian bonds. But overall, I think given the low budget deficit and the substitution effect, if people aren't investing in treasuries, are they more likely to be investing in more friendly countries, like this new
Right.
relationship between Canada and Europe,
Right.
even at a lower interest rate, they'd potentially be more likely to borrow in Canada.
Moving to Banco de Mexico. Banxico just cut rates by 25 bips to 7.75 during the 7th of August meeting. And it seems Deputy Governor Jonathan Heath was perhaps not so convinced about the inflation abatement. In any case, so far, Banxico has cut rates by 325 bips since early 24, given the relative step down in core inflation and an economy struggling from, among other things, a trade war with its largest trading partner, the US. It now seems open to smaller incremental data-driven cuts. So how convinced are you about this policy direction, John?
Yeah, and you are in an incrementally different environment where you're talking about emerging markets, Brazil, Mexico, Colombia, etc. They still have the characteristics of an emerging market, despite the very close trade relationship with the US. But the fact is that yes, even with 325 basis points of cuts at 7 3/4 versus core inflation of only 4 1/4, you got 350 basis points in real yields, which is much higher than say the US or Canada in terms of their rate. But on the other hand, the short rate differential that arises from that is actually less than its long-term average with the US. So you don't want to get into a situation where folks, look at the trade wars and they look at some of the elements, other security elements going on in the Mexican economy and start to sell Mexican pesos. I'm not talking a Turkey situation or an Argentine or a Brazilian situation, but you want to make sure you have those stability concerns. And ultimately, it ends up with the fact that emerging markets have to sustain a higher real yield than other countries, regardless of economic circumstances. Now, whether that real yield at 350 basis points will prove to be too high, I do think it's prudent of Mexico to, again, keep some dry powder, look at how the data evolves, look at how confidence in the Mexican peso evolves during the ever-changing nature of the trade war with the United States, and adjust rates incrementally based on the new data that's coming in. I think that's a fairly wise decision.
Right. Well, that's all I have for today. Your perspectives on rates are always top-notch, John. It was indeed a pleasure to hear you speak. Thank you once again for your time.
And it's been a pleasure to talk to you and field so many erudite questions. Appreciate it.
Thank you very much for the time.